Who really owns Coca-Cola? I mean, is it one person, a family, or something much bigger?
That is the million-dollar question, isn't it?
Right. Welcome to today's deep dive, everyone. Today we're unpacking a really detailed business and market analysis that was provided to us by the Asia Grocery Company. Our mission really is to trace the complex historical transition of Coca-Cola's ownership.
Yeah, and we're going to look under the hood, so to speak, to see how a publicly traded, global, fast-moving consumer goods company and FMCG giant actually operates in practice.
Exactly. And look, whether you are an importer, maybe a B2B trader, or just someone trying to understand the nuts and bolts of global business at scale, tracking this timeline is essentially a masterclass in supply chain evolution. So I'll be guiding us through the historical corporate structure transitions, those distinct pivot points that really change the trajectory of the brand.
And I'll step in to unpack the financial and the operational why behind those pivots, focusing on how those specific decisions impacted margin expansion, global logistics, and honestly, the realities of modern institutional ownership.
Perfect. Let's start right at the origin. We are in, let's see, 1886. Atlanta, Georgia.
A very different world back then.
Very different. So a pharmacist named Dr. John Stith Pemberton creates this brown liquid he actually calls a nerve tonic.
Right, right.
And he's selling it for literally 5 cents a glass at a local spot, Jacob's Pharmacy.
Yeah.
It is a highly localized, highly manual operation at this point.
It was. And, the 19th century patent medicine landscape was just incredibly crowded. Plus, Pemberton was dealing with severe personal health issues at the time.
Oh, right, yeah.
So he needed immediate liquid cash just to sustain his life, let alone his business.
Yeah.
And because he was operating under this intense financial duress, the early capitalization of this invention was, well, it was chaotic.
It's just a mess.
Yeah. Right, totally. He essentially began selling off fractional pieces of the operation to multiple different parties.
So instead of raising traditional capital like we'd see today, he's just carving up the actual operational rights.
Exactly. He fragmented the company's core assets. So you ended up with this bizarre scenario where certain investors controlled the manufacturing rights for the physical formula.
Wow.
While entirely separate partners held overlapping regional distribution agreements.
Which is insane. For anyone managing a B2B operation today, you recognize that immediately as a structural nightmare.
A total nightmare. No single entity had the clear legal authority to dictate the brand direction or control pricing or even scale the manufacturing process efficiently. It was basically a localized product trapped in a completely disjointed operational model.
Okay, so that perfectly sets the stage for Asa Griggs Candler. By 1891, he steps into this tangled web of fractional ownership and just systematically rolls up the entire operation.
Yeah, he cleans house.
He does. He acquires complete exclusive rights to the formula, the trademark, the entire business infrastructure, and he does it for a total investment of roughly $2,300.
Which is wild. I mean, securing the IP for that price is a historic acquisition in itself. But Candler's real genius, his real contribution, was the immediate strategic pivot he made.
He completely changed the game.
He did. He looked at the existing business model of selling a nerve tonic and recognized the inherent ceiling on that market share. Making medicinal claims immediately invites regulatory friction. And more importantly, it restricts your total addressable market to only people who are actively feeling unwell.
Right, so he strips away the medicinal positioning entirely. He markets it simply as a refreshing beverage for everyday consumption.
Which instantly blows the total addressable market wide open.
Wide open, and then he backs that up with aggressive demand generation. He introduced some of the very first free drink coupons in history just to force consumer trial.
Yeah, but generating consumer pull is only one piece of the puzzle. Fulfilling that demand across state lines requires real infrastructure. So Candler established a formalized network of syrup distributors.
How did that work exactly?
Well, he standardized the manufacturing of the concentrate in centralized hubs and then shipped that syrup out to soda fountains nationwide. He created a replicable system, standardizing the product quality, while offloading the final retail execution to independent pharmacy owners.
That makes sense, but the real logistical leap happens a few years later, right?
Yeah.
In 1899, with the introduction of the franchise bottling system.
Absolutely pivotal moment.
Candler actually sold the exclusive rights to bottle the beverage to 2 lawyers from Chattanooga, Benjamin Thomas and Joseph Whitehead, and he sold it for just $1.
It's incredible. That $1 contract is arguably the most important document in FMCG history.
Really? Why so significant?
Because by separating the brand ownership from the physical bottling operations, Candler insulated the parent company from massive capital expenditures. Think about it. Building bottling plants, buying glass, maintaining fleets of delivery trucks. That requires intensive capital and carries incredibly high operational risk.
So the franchise model shifted all of that CapEx risk to independent regional business owner.
Exactly. Coca-Cola simply manufactured the high-margin syrup and protected the intellectual property.
It's an incredibly asset-light scaling mechanism. It allowed the brand to just sweep across the country without the parent company having to finance hundreds of factories themselves.
Brilliant strategy.
It really was. And that expanding footprint brings us to the end of the Candler era and the big transition to the public market. So after incorporating the company in 1892 and running it for decades, the Candler family eventually decides to exit.
In 1919.
Yes, 1919.
Yep.
They sell their controlling interest to a syndicate of investors led by Ernest Woodruff for $25 million.
And just note that valuation jump. From $2,300 to $25 million, it reflects the sheer scale of the bottling network they had built. The Woodruff Syndicate didn't just buy a recipe, they bought an entrenched national supply chain.
But a $25 million acquisition in 1919 required some serious financial engineering.
Oh, absolutely. The syndicate took on significant debt to finance the buyout. And the immediate solution to clear that debt and fund the next phase of growth was tapping the public market.
Which triggers the initial public offering later that same year. They list on the New York Stock Exchange under the ticker symbol KO, pricing the shares at $40.
And that fundamentally rewrites the company's DNA. They transition from a private family office into a publicly traded corporation.
What's fascinating here is, well, why do that? What's the trade-off in simple terms?
It's a great question. The macroeconomic timing is crucial here. Post-World War I, their ambition was true global expansion. And funding international supply chains requires capital reserves that a private family balance sheet simply cannot sustain. Accessing institutional capital markets provides that vast liquidity.
Trading absolute founder control for capital access.
Exactly. The structural trade-off, of course, is the introduction of strict fiduciary accountability. The executive team now has to answer to a diverse shareholder base. They have to provide transparent quarterly reporting and balance short-term dividend payouts with long-term infrastructure investments.
Okay, here's where it gets really interesting. Let's run the math on the long-term impact of that public structure for a moment.
I love this part.
It's wild. If an investor purchased a single share at that $40 IPO price in 1919 and simply reinvested the quarterly dividends, never adding another dollar of outside capital, that single share would have compounded into a position worth over $10 million today.
It's almost hard to wrap your head around.
Right.
But that figure perfectly illustrates the mechanics of compound dividend growth. It also really highlights the resilience of the public corporation model versus founder ownership.
How so?
Well, a private company is incredibly vulnerable. They face succession planning failures, family disputes, estate taxes. Transitioning to a publicly traded structure decoupled the brand's survival from any single individual. It democratized the financial upside and created an institutional framework designed to outlast its founders.
Which perfectly transitions us to the modern landscape. That democratization has evolved into massive institutional concentration today.
It has.
So who holds the shares today? Coca-Cola operates on a widely distributed ownership model, but over 70% of the outstanding shares are controlled by institutional investors.
We're looking at finance heavyweights here. Vanguard holds roughly 8.5%, BlackRock sits at about 7.5%, and State Street Corporation controls around 4%.
And when we analyze those specific entities, we really have to distinguish between passive and active capital.
That's a good point. Break that down for us. Sure. Vanguard, BlackRock, and State Street are primarily managers of passive index funds and ETFs. Because Coca-Cola is a massive component of major indices like the S&P 500, these funds are structurally mandated to hold the stock.
Right, it's automatic.
Completely automatic. As global capital flows into retirement accounts and index funds, those managers automatically purchase Coca-Cola shares to maintain their index weightings. This creates a formidable baseline of liquidity and share price stability that smaller, privately held competitors simply don't enjoy.
Then we shift to the active capital side, which brings us to the single largest individual shareholder, Warren Buffett and Berkshire Hathaway.
The Oracle of Omaha.
Yeah, they hold approximately 9.3% of the entire company, representing about 400 million shares.
What's fascinating here is Buffett's initial accumulation of that position in 1988. It is a masterclass in contrasting market sentiment with underlying business fundamentals.
These people were skeptical at the time, right?
Very. The broader equities market was still incredibly jittery following the 1987 Black Monday crash. Furthermore, Wall Street was heavily discounting Coca-Cola stock due to the lingering brand damage from the whole new Coke launch a few years prior.
Oh, the new Coke debacle.
Exactly. The market perceived vulnerability.
But Buffett looked past the temporary PR crisis and focused on the entrenched B2B relationships.
Right. He identified what he famously calls a durable competitive advantage or an economic moat. He didn't just see a popular consumer brand, he saw an irreplicable global distribution network.
You can't just build that overnight.
No, you cannot simply raise $1 billion in venture capital and immediately replicate a century of exclusive bottle agreement, shelf space dominance, and supply chain logistics. Coca-Cola possessed incredible pricing power and highly predictable, immense free cash flow generation.
And the financial return on that specific bet is staggering. Berkshire Hathaway's original $1.3 billion investment has compounded in value to over $24 billion today.
Incredible return.
But honestly, the capital appreciation is secondary to the cash flow mechanics because of the power of dividends. Berkshire Hathaway collects more than $770 million annually in dividend payouts from Coca-Cola.
Just think about that.
That's nearly $1 billion in liquid cash injected into Berkshire's balance sheet every single year without them ever having to liquidate a single share.
And that dividend yield is exactly why institutional investors anchor their portfolios with these FMCG giants. It provides the capital reliability needed to weather varying economic cycles. But managing a corporation of this size with that level of institutional expectation, it requires a highly specific governance structure.
Okay, let's unpack this because it's the major point of confusion for a lot of people. The executive leadership steering the company. They do not own the company.
Right. Management versus ownership.
James Quincy is the CEO. He drives daily operations, international expansion, massive portfolio decisions. But his authority is entirely delegated.
This separation of ownership and management is the absolute bedrock of corporate governance. The millions of retail investors, alongside giants like Berkshire Hathaway and Vanguard, they elect a board of directors.
And the board represents the shareholders.
Exactly. They act as the fiduciary representative. The board dictates executive compensation structures, they approve massive capital allocations or acquisitions, and they rigorously measure the CEO's performance.
And if he underperforms?
In the FMCG sector, that performance is typically judged on operating margin expansion, the resilience of the global supply chain, and steady dividend growth. If the executive suite fails to hit those metrics, the board has the authority to replace the management team.
Because the complexity of the operation James Quincy and his team are managing goes far, far beyond a single red can of soda. They are executing global portfolio management on an astonishing scale. The Coca-Cola Company manages over 200 distinct brands globally.
The operational bandwidth required to manage that portfolio is immense. We are talking about highly diverse categories. Sparkling beverages, purified water, coffee, plant-based dairy alternatives, sports drinks.
Out of those 200 brands, 21 of them generate over $1 billion annually in retail sales on their own. Brands like Sprite, Costa Coffee, Smart Water.
All under one umbrella.
Yeah. And they're pushing this portfolio into over 200 different countries and territories.
If we connect this to the bigger picture, the sheer physical logistics of that distribution network bring us right back to the fundamental genius of the franchise bottling system Asa Candler initiated, but obviously scaled to a modern, digitized global economy.
Right.
Coca-Cola produces the proprietary concentrate, but moving millions of pallets of physical liquid across sovereign borders, dealing with localized customs, currency fluctuations, and varying retail landscapes, that requires a staggering web of B2B relationships.
Definitely. And if you are an international distributor or maybe a retail chain buyer listening right now, you intimately understand the friction of cross-border logistics. Getting a product from a manufacturing hub to a regional grocery shelf is fraught with supply chain vulnerabilities.
Exactly. The parent company relies on highly specialized regional infrastructure to bridge that gap. For distributors looking to source massive FMCG brands in bulk for export markets, the logistical burden is immense. You're talking about consolidating pallets, ensuring stable supply, negotiating competitive pricing.
It's a massive lift.
It is.
Okay.
And this is exactly where specialized B2B partners like Asia Grocery Wholesale, or AGW, integrate into the global ecosystem. Backed by the deep operational expertise of the Asia Grocery Company, AGW acts as a critical bulk sourcing hub.
They absorb the complexity of the wholesale export market.
Precisely. They provide the essential infrastructure that keeps these massive global supply chains moving efficiently. When a regional retail market needs consistent access to a diversified FMCG portfolio, they require an export partner capable of navigating volume logistics and delivering competitive wholesale pricing.
So they basically act as the bridge.
Yeah, facilities and networks like those operated by AGW ensure that the concentrate manufactured by Coca-Cola actually completes that final, most difficult leg of its journey to the international consumer. It's this invisible, highly efficient wholesale machinery that allows a centralized brand to achieve true decentralized global scale.
So what does this all mean? When we look at this beautifully complex, interdependent ecosystem, passive index funds and active investors provide the capital stability. The board of directors enforces the strategic governance. The executive management team oversees the innovation and marketing of 200 different brands.
Massive machine.
And then the independent bottlers, wholesale hubs like AGW, and B2B traders handle the physical reality of actually moving the goods across the planet.
Yeah. And none of which functions without those initial structural shifts we talked about. The transition away from a fragmented, localized patent medicine into a standardized franchise distribution model that laid the tracks.
The 1919 IPO provided the engine and the capital fuel.
Exactly. Everything we see today, from the billion-dollar brand acquisitions down to the specialized export logistics, is a direct continuation of those foundational corporate structuring decisions.
Bringing us back to the central question we started with at the very top. Who actually owns Coca-Cola?
The ultimate answer.
Right. After tracing the timeline, from a small Atlanta pharmacy to the massive boardrooms of institutional finance, the reality is that nobody owns it outright. The ownership is entirely distributed. It's a democratic, decentralized empire that belongs to millions of people simultaneously. Retail investors, pension funds, major financial conglomerates.
And reflecting on global trade, that widely distributed ownership is really the ultimate competitive advantage. A tightly controlled private company is often rigid. It's subject to the limitations and biases of a few key individuals.
Public ownership forces adaptability.
It does. Especially with heavy institutional backing, it forces an organization to be ruthlessly adaptable. It demands operational flexibility and provides the bottomless capital reserves required to absorb macroeconomic shocks. This structure is exactly what has allowed the brand to survive over 135 years of economic upheaval, shifting consumer trends, and global crises without losing its dominant position.
It really changes how you look at the supply chain operating around you every single day.
It should, yeah.
So we'll leave you with a final thought to ponder. The next time you're reviewing a vendor contract or maybe assessing a new regional supplier, consider the long-term trajectory. If a $2,300 investment in a struggling pharmacy tonic can evolve into a highly distributed $250+ billion global institution purely through strategic restructuring, look at the local startups in your own city today.
That's a great perspective.
Which of those small, privately owned ideas are quietly laying the groundwork to be collectively owned by millions of people a century from now? Something to think about. Thanks for joining us on this deep dive. Keep analyzing the structures behind the products, and we will catch you next time.